Welcome, and thank you for joining the Exceptional Advisor webinar series. I'm your host, Tony Davidow. I'm really thrilled. I think we have a tremendous program here today, but let me provide a couple housekeeping issues before we get started. For those of you that are new to the Exceptional Advisor webinar series, the program is taken directly from the Investment and Wealth Monitor, one of the premier publications of the Investment and Wealth Institute, where we're trying to provide topical and timely articles to help advisors deal with some of the challenges that they're facing with clients, the industry, the changing dynamics, which is a perfect setup for our discussion today. The content format is typically either in the form of formal presentations, an economic outlook. From time to time, we'll have panel discussions or academics. Today, we're going to have a fireside chat. We're going to have a very casual conversation with a real industry leader talking about the future of wealth management. Future modules will cover topics such as investment and wealth management, which aligns with our CIMA designation, wealth management, which aligns with our CPWA designation, retirement, which aligns with the RMA designation, and then behavioral finance. If you have any questions, feel free to submit them to the console, and we'll try to take them in the order that they come in. Also, I'd like to remind you there are a couple items in your console that you can download. One is an article from our presenter here today, Neil Bathon. And then there's an article, some research done by the Investment and Wealth Institute on the future of wealth management, some really insightful things that may help you with your practice and you may want to consider as you think of the challenges before you. So without further ado, it's my distinct pleasure to introduce our presenter here today, Neil Bathon. Neil is an industry pioneer. He's the founder of ESG Research, which really provides great independent research and analysis on sales, marketing and product innovation going on across the industry. He works with about 50 investment management firms across the industry of all size and sophistication. And I think he's been one of the real great voices in the industry as we've really grown from an industry dominated by mutual funds to include such things as ETFs and hedge funds, other types of alternatives. And as we get into in our discussion here today, product innovation is really at the forefront as we try to determine how best to meet the needs of our clients, especially in this challenging environment that we live in here today. So I'm thrilled to have Neil. Neil, thanks so much for joining us. I'll give a little bit of a brief overview and then I'll throw a question to Neil to kind of start our discussion here today. But we did want to frame it in the broad context of the future of wealth management. And this does follow an article that Neil has written for the Investment and Wealth Monitor, where Neil and I did a Q&A similar to what we're doing here today. And we covered a wide range of topics, things from interval funds and tender offer funds and non-transparent strategies, direct indexing, ESG. And what we really wanted to focus on are what are the trends that are going to transform the industry and what are just ideas that fizzle out. And for folks like Neil and I who have been in the industry for a long time, there are a lot of these trends that sound good at the beginning and they do fizzle out, that really don't go anywhere, and others serve to be transformational. So we want to get into that a little bit. We'll talk a little bit about some of the M&A activity going on across the industry, and Neil has some very strong views on that. And then we'll talk about sales and marketing and the impact of COVID. And not to steal the punchline, but I think COVID likely accelerated some of the trends that were already underway. But I think once the genie is out of the bottle, I think some of these things will continue to be transformational in the years to come. So Neil, welcome. Thank you so much for joining us here today.
You're welcome. It's a pleasure to be here. Thank you.
Let's start with the big one, and that is, just as we think about the landscape here, what do you think the big trends are? And I know when we discussed in our article, we were a couple months early. We were just starting the year. We're thinking about what 2021 will be. Maybe we take it a little broader than that. What do you think the big trends will be in 2021 and 2022? What are the things that we're starting to see happening now?
I think one of the big trends that its roots are kind of starting to kind of take hold is the interest in the use of direct indexing or customized portfolios. I think that's one of the ones we have our eye on for our clients, and kind of moving away from prepackaged mutual funds or ETFs and really moving more towards customization. So I think that's a big trend. I think that could be one of the most disruptive changes in the business. And obviously there's some acquisitions that expedite that. Morgan Stanley with Eaton Vance, which had the Parametric unit. So that one has some big backers to it already.
Maybe for those folks who aren't as familiar, I know we've covered direct indexing in the Investment and Wealth Monitor, but maybe it's kind of worth revisiting with some people. So how is direct indexing different than buying an ETF? Maybe as a starting point on that discussion.
I mean, I take direct indexing to be taking a core portfolio and customizing it to fit the precise requirements of your clients. So if you want the S&P 500, but you want some adjustments made for some ESG preferences, you basically get the S&P 500 delivered in a separate account, and then the overlay kind of keeps things true while adjusting for particular preferences. Or maybe it's existing holdings or maybe some tax treatments that you want to be adjusted. So it's a separate account at the end of the day, but it kind of tends to mirror, at least in these early stages, an existing portfolio.
And you mentioned Parametric, and again, not to favor one firm versus another, but I know one of the things that Parametric would say is, well, this has actually been around for a while, but the trend seems to have accelerated. So to me, you mentioned two things that I think are driving some of that, and that is taxes, obviously tax management, very important. ESG, which is a topic we'll get into, but a lot easier to reflect your ESG views if you're developing a direct index strategy. But I think the other thing that maybe isn't getting enough attention is this whole fractional share movement, which makes it easier to buy those smaller increments.
Yeah, some of the acquisitions, Schwab, Goldman, JP Morgan, BlackRock with Aperio, whether it's fractional shares or some of the tax loss harvesting capabilities, those firms in particular, I think, have created a nice competitive advantage for themselves as it relates to the execution side of things. It definitely has been around for a long time. Parametrics, I suspect, in the lead, but getting it to be scalable is really the challenge, and I think it's taken a long time for some of those firms to figure out how to get it there.
Yeah. So we think direct indexing is definitely here to stay, and we think it's a great way of kind of reflecting individual preferences and portfolios. And maybe, this is kind of the natural sort of segue here. You and I, who have been in this industry for a long time, have heard, non-transparent ETFs for a really long time. And I always thought to myself, what is the problem we're trying to solve for? We haven't really seen explosive growth in non-transparent ETFs. What are your thoughts on non-transparent ETFs, whether they make sense, whether they're actually solving for something? And if they are actually going to be a viable solution, where are they taking market share from the mutual fund industry or from the ETF industry?
Did we screen participants today to avoid any client conflict I might have with my next comments? Well, we'll find out tomorrow morning, I suspect. I just can't quite figure out why there's a need for non-transparent ETFs. I agree with you that you don't need them fixed income, so that's the whole swatch of strategies you take off the table, right? Because you just don't have to worry about the trading transparency issues. You probably don't really need them for large cap domestic equity. The small cap funds have capacity issues, and you can't really shut off an ETF, so I'm not sure an ETF of whatever form works for small cap. Right now, at least international is not available to be used, international strategies. So I know there's all these, I don't question that ETFs have an advantage of without the transfer agent fee and with tax efficiencies, but the non-transparent versions, I just can't quite figure out where the demand is going to come from, because it's, as you've mentioned, it's not there today. And if they do take away, I guess maybe we come to view them as share classes in general, and the way they are used at Vanguard, and you just bolt it on to an existing iShare, advisor share, institutional share class. But it's maybe this is what I'm horribly missing, but I just can't quite see why the non-transparent is going to find a home. I think there'll be a lot of activity because there's so much hype, and some heads of asset management firms feel pressure to kind of be doing something, but I just don't think it solves any real need in the marketplace, other than at the end of the day, portfolio managers who believe their intellectual property is so valuable that it has to be shielded. But
yeah, thank you for that, because it seemed like a problem that we're solving for that doesn't really exist, because we've got an ETF, right? So if the whole idea is having, you know, a smaller package product at cheaper pricing and tax efficiency, we already have an ETF, we already have a mutual fund, and this middle ground, I wonder what it is solving for. And like you, I've heard the hype about it, and there has been a lot of activity. I haven't seen a lot of follow through. And I guess I would wonder too, if they were taking market share from anyone, maybe it would be from a expensive mutual fund structure. And I think the way you described is the way that I've been thinking about it, which is maybe it's just a share class. So if you're a mutual fund family, you have your A, your B, your C, and then you've got your non-transparent sort of version, and you almost kind of think of it that way, so you're not competing against one another. But I wondered about that, and we've certainly heard the noise for a while, but not a lot of follow through.
yeah, and there's still some problems. For instance, structurally, the 401k, you have to have that brokerage window, right? So if you don't, you can't use an ETF. So there are some limitations to some of the structures, whether it's non-transparent or not, that make the mutual fund kind of still need to be around. But and this kind of contributes to my sense that if you really want customization, and the trend towards customization is in all aspects of clients' lives, and why wouldn't you move to a separate account that delivers even greater tax efficiency? Right. And yeah, I guess some of the motivation or incentive, I think, behind the use of separate accounts. I know it's a higher net worth client solution right now, but I do think as firms get the operational back office scalability issues resolved, that'll come down market pretty quick.
If I can, and I have to apologize too, I'm trying to think of like the questions that would be interesting to our audience, and I realize that some of these may be ticklish for you based on your involvement with some of the firms you're working with. But I know one of the other things that has come up in the industry is this whole idea, if you could actually take mutual funds and convert them to an ETF structure in a more tax efficient way, that would potentially be a game changer. And I know my understanding is I think one firm has done that. If that could be done, would that make it more appealing to make that transition if you could easily move those assets without incurring the taxable event?
Oh, absolutely. I mean, I think I don't know if I want this to happen or I think it's going to happen, but whatever the difference is, I think we will probably realize that non-transparent ETFs are not really necessary. They don't solve for anything, and that mutual funds will be converted to ETFs. Will fix the 401k problem, and will probably yes, because an ETF does have its tax and fee benefits that are clear. So I think the one lingering thing is still going to be the capitalization, right? So if you can't turn off an ETF, it does have some challenges in some very narrow ranges, but I think you're right, Tony. I think that's where we're going to move. I think you'll see mass transformation of mutual funds into ETFs because of their clear advantages, just not the non-transparent or semi-transparent version.
I hope everyone's listening to that. So you just described, where the puck is going here, right? So it's going to be product agnostic. ETFs is just a structure that we can potentially put these things, move these assets into. You get the tax advantages of the structure. It seems like that's a pretty big migration for the industry. Or how long do you think that will take to play out?
Well, I do think it's a migration. But to tell you, what we are trying to counsel our asset management clients on is this might not create incremental opportunity for you for sales growth. It's and if you really want to play in an area that's going to see much more market share gains relative to packaged products, I do think it's going to be back in separate accounts, whether it's the traditional separate account that everyone's familiar with, or these direct indexing customization offerings that are becoming more and more popular. So I think you'll see a lot of activity for mutual funds and ETF transformation, but I don't think it does a whole lot to change anyone's relative competitiveness at the end of the day.
If I can jump around a little bit, but as you respond to these things, there are thoughts that come into my mind as we've been debating a lot of these issues on the editorial advisory board, and one of those is the growth of models, which I view as they're really just separate accounts using ETFs as raw materials primarily. And we've seen a lot of asset managers getting into that space. And the argument that I've heard from many of those asset managers is it gives them the opportunity to get a larger slice of the pie and really to leverage their intellectual capital. I think for the advisor, what it does is it kind of frees them up so their job isn't building portfolios on their own, but leveraging the expertise of those third-party managers to use these models. But I know you have some strong views on models as well. Maybe you could just share that with the group, and then we can kind of delve into that a little bit.
Sure. This is one of the areas that probably 3 years ago, my views would be decidedly different than they are today. I was a huge advocate of what was, I believe, to be a massive growth of models about to kind of hit the scene. And I guess over time, I've more and more come to realize that as advisors have been putting models in place for their clients since the beginning of time, and they didn't need it to be pre-packaged in order for them to put together an asset allocation. So I do believe that more differentiation will come from service around more holistic financial planning, and maybe investment management fades a bit into the background. And if that's the case, then an advisor using a model, certainly for the smaller accounts, makes all the sense in the world. But I guess, I don't know, I think maybe really models it's marketing or it's packaging that's created the buzz, because everyone's been doing asset allocation, as I mentioned, but maybe it's more these sub models or these sub solutions that I think now I put more time and attention into. So fixing for ESG or volatility, or generating more income, dealing with some tax issues or volatility issues. I think bolt-ons to a holistic kind of asset allocation model that kind of makes the refinements or tinkerings that kind of help refine the ultimate outcome for the client. I think I'm shifting towards that's where the growth is going to come from in prepackaged offerings, not these big, broad asset allocation models, whether it's Morgan Stanley's or it's some third party, JP Morgan. I just don't think there's nearly as much opportunity for those broad-based models as I did a few years ago. The only exception, I guess I'd say, is money that's still in brokerage that needs to move over as that shift to advisory continues. I could see that working its way into a model when you make the transition, but that progression has been in place for many, many years now and has been drawn down upon. So,
yeah, interesting.
But just to highlight, Tony, I'm definitely more contrarian now than you'll find in the industry. I think most people believe that models growth is going to go off the charts, and that I guess I'm souring on that notion just a touch.
Okay. Well, that's what we love about you. You've got your own point of view and you're not bashful about sharing it. You've mentioned a couple times ESG, which certainly from my vantage point, and again, if I think of the time that we spent on the editorial advisory board thinking about topics that we think could be of interest to our members, ESG has definitely percolated to the top. And I would say 2 or 3 years ago, there's probably a lot of noise, not a lot of follow through. I think recently we've seen a lot more follow through. And I know we had a little bit of a discussion on ESG, which I think would be fun to kind of revisit here. But what are your thoughts on ESG? What are your thoughts for asset managers who are trying to kind of chase the puck yet again, where the money's going and getting into this space?
We do pretty regular surveys among advisors and across all channels and book size and practice types. And at the retail level, it's hard to find a meaningful momentum around ESG. And it's also hard to find it in flows into the products. I don't question that on the institutional side, there are some absolute requirements in terms of ESG, and that there are specific mandates. I don't question also at distributors that some of the home offices and the research departments are gearing up and having a ESG lens or screen, or if not a dedicated team to it. But it might be building up, but it's not clear yet in terms of actual demand reflected in asset growth and sales. I also begun to see, we don't really do this sort of work, more and more challenges to the performance benefits. I think right out of the box 3-4 years ago, there was just a steady flow of papers that suggested that there's no question about the likelihood of outperformance relative to non-ESG offerings. But I think more and more people are starting to pull apart the numbers and realize, well, yeah, if you weren't in energy in the last 18 months, you probably had a decided advantage, and most ESG strategies aren't in energy sectors or holdings. So I think there are more questions about standalone products and the demand for them. I feel much more comfortable around what I see happening to firms fully integrating ESG principles into how they evaluate securities. So I don't know that I think the window for standalone ESG products might be more limited than many of our clients even feel. But I don't question that ESG having to be a strict, properly, fully able to articulate discipline within the research and portfolio management teams is an absolute requirement. A little sidestep though, some of the research we did with the due diligence teams at distributors over the last 6 months, 3-4 months, would suggest that diversity and inclusion has kind of bumped ESG back a little bit. It's kind of overlapping a little bit, but much more interest from due diligence groups to want to know about what the diversity, inclusion, and equity principles are at asset management firms, which sidelined just a bit the ESG focus for a little while.
Yeah, that's interesting. So maybe we'll just take this discussion a little further. And I've done a lot of research on ESG. It's something we've written about and published quite a bit about over the years, just because again we seem to have this polarizing sort of view. And a lot of the research that I've seen suggests that clients absolutely want to learn about it, and they expect that to come from the advisor. But to your point, a lot of advisors are saying, hey, I don't want to spend the time to really understand it. I think part of it is maybe a bias. People of our generation, we may think of kind of the first generation SRI, which was negative screening, and therefore we understood there was a price that you paid, and by excluding things, you're going to underperform. And I've seen a lot of data recently that suggests that these strategies do in fact outperform, not just because of the E. And I think that there's kind of this, in the marketplace, I think we tend to focus more on the E, not on the S and the G. And the S and the G, I think based on what I've seen, the S and the G actually seem to drive more of the outcome over time, because if you think about it, those are really important practices, right? So if you have a strong social infrastructure and you've got engaged employees, you're likely going to have a more conducive work environment, which means you're more productive and you do a better job. If you have strong governance, better risk controls and checks and balances and all of that, you're going to avoid big blowups and big risk over time. So I think there's certainly ample research to suggest that the E, the S, and the G should be thought of as 3 individual pillars. And the S and the G are really important dynamics that sometimes get overlooked. And it kind of dovetails with your comment that I think due diligence folks, I think clients are now starting to ask a lot more questions about the S and the G and the diversity inclusion sort of practices of the firms that they're working with. And I think that almost forces the advisor to at least be versant in it, whether they use them with clients or not. I think there is a paradigm shift that advisors need to at least have those discussions with their clients. What do you think about that?
I think that I think most asset management firms would say that they've been on top of the governance component. That's foundational to the research they do when picking securities. So I would have said that more questions come up around the E and the S, and that the definitions are a little more squishy, and what someone might define as compliant with environmental or societal issues at one firm might be different from somewhere else. And so I also have a little bit of insight based on our advisor research that impact, I think when clients get into it with their advisors and they believe that they're having some positive impact, but then they realize, well, I'm not really, because I picked some firm over another firm, I haven't really influenced the decision making at that firm. I'm in a sense just rewarding them with a higher stock price. But I think when they understand what impact investing is, it's a very small slice today, but I think that might have more alignment, probably a higher net worth client, but the actual ability to kind of see through your investment to what actually came of it in terms of how it had some impact in the marketplace. I think that if you break impact out from traditional or standard ESG investing, I think that is a small but a more interesting growth area for the future.
Okay. If we can, you mentioned some of the M&A activity earlier on, and I know we got into it a little bit, and I think there's different ways of kind of thinking about it, M&A. So there's the M&A of a Morgan buying a Parametric. There's asset managers buying asset managers. There's asset managers making bolt-on acquisitions, buying private equity firms or alternative investment firms because they want to kind of broaden their distribution. Do you think these M&A trends are trends, or do you think it's just one-off sort of transactions?
I think you have to break the industry into its little sub pieces, and then I think you could say there are trends in place. So asset management firms that have corporate parents, whether it's a bank or an insurance company, if Wells Fargo spun out their asset management business, I think that's a pretty good, those types of strategic parents, I think will evaluate their properties. I think even going back to Mass Mutual with Oppenheimer and doing the deal with Invesco, I think they evaluate whether or not the business is going to be worth more in the future and what the investments are going to be required of them to get it there. And I think for that group of type of firm, I think you'll see a fairly steady trend of M&A activity. But it may not be most of the assets, but most of the firms are privately held entities whose margins are quite strong, whose assets are up significantly over the last several years. Even if they've been in net outflows from a sales perspective, their assets are way up. They probably have some incremental expenses, cybersecurity and operational things, but their probably margins have held steady despite all the pressure or what you hear about kind of compression around margins and fees. But so I think most of the firms are pretty healthy, and I don't think there's a compelling reason for them to sell. I think portfolio managers who own asset management firms make horrible decisions about their own companies, about what the right valuation is, and miss the mark. And like anything, I think they remember what they were being offered in 2013 or 14, and maybe they aren't getting that price today and think they can hold out and get back to it. But I don't see enough compelling reasons for the bulk of the firms for it to be more of a trend across the industry. But I do see that small subset kind of continue to be whittled away about when you have a strategic parent that owns the asset management business.
And there's a little nugget in there in that response. And I remember our discussion where I suggested that there was fee compression, and you actually pushed back to say you don't see that, or at least not for strong managers with good products. So I think maybe the market has a misperception that asset managers are struggling. You're actually providing the counterpoint, which is they're doing very, very well because their asset base has grown substantially over the last couple of years.
Yeah, it's interesting. Some of the fee compression, or if we just take equity, your average U.S. equity fund, over the last 10 years, they've lost about 9 basis points. And some of that is, it's not that they've been lowering their fees. I mean, some of the assets have moved their way to, Dodge and Cox and American funds are at the lower end of active. So that's excluding passive. That's not even the effect of those. But the other kind of little trick is that as assets move up, a lot of these firms have break points in their management fee structures. And so they hit an asset level and then the fees drop another basis point or two. So some of it is expected and planned. It's not artificial and forced on them. So I don't see, I'll just make the blanket statement. I don't see fee pressure, margin pressure, profit pressure at really any of the firms that we work with in the industry. And that's from $1 billion to $250 billion. It's across the whole range.
I would say, coming from your vantage point, that's a really important statement. Thank you for that. Let's talk a little bit about alts. And again, I feel very strongly about alts and the value they have in their portfolio. Not to kind of lead the jury here, but I know that you're not maybe as high on it as I am. But maybe if we could talk about alternatives kind of broadly, what you see as the opportunity for alternatives broadly, and then specifically the growth of registered fund products. And one of your colleagues, Patrick Newcomb, actually wrote an article for the Investment and Wealth Monitor focusing the growth of interval funds and tender offer funds. So I'm curious if you could maybe just opine broadly on alternatives, and then specifically on whether registered funds are a way of kind of helping advisors get their foothold into the alternative space?
Well, all right. So this will lose just a couple more clients probably. I think that the benefit of that is education ultimately, because it failed miserably as a practical exercise in terms of bringing a meaningful portion of protection into a client's portfolio. The 4 or 5% average weighting that advisors got to just was never going to have meaningful impact. And the surge after 2008 into 2009 faded already by 2014, 15. So it wasn't able to be sustained in a liquid alts. And I just think it's not the right structure. So, and I don't really think that there's likely to be a rebound. I mean, there's certainly market neutral, and there's some products here and there that are doing well, but there's so many different categories within what we call alts in our industry that you kind of have to parse them out a bit. But to your other point, I do think interval funds, they're not great for advisory, but they're a really neat product for delivering a less liquid security. You can tender quarterly, you can buy on an ongoing basis. I think it's the right way to deliver that type of less liquid security. Having said that, though, private placements have been doing really well. We don't work with it, but like a firm like Neuberger, we hear about all the time in terms of the raise that they're able to do in their private placement. So I think closed-end funds have had a big comeback, and there's some interesting leverage things and less liquid securities they're working with. Interval funds, I think, have a nice bright upside, and if they could just work in advisory, I think it'd be even exponentially higher. And then private placement. Hedge funds had a really, really tough go performance-wise, but it looks like they are coming and bouncing back much more quickly. I guess I would have guessed in terms of, I thought they were bloodied and damaged, but maybe not as deeply or badly as I had thought.
Yeah, I mean, there's a couple things in there. I think one is, I think across the industry, the percentage allocation alternatives has been so low historically, partly because I think advisors felt like, gee, I'm getting this really great return coming from the equity markets. Why do I need to kind of dabble into something that's more complex and it takes a lot more time to explain to my client? But if you believe that the future returns are going to be lower, which most capital market assumptions that I look at are suggesting substantially lower equity returns in the future, things like private equity are appealing. And I agree with you. I think that things like interval and tender offer funds are kind of that bridge, because as much as the QP structure may be the preferred structure, not as many clients qualify to get into those, but the accredited investor products, the interval and the tender, now allow advisors to allocate in larger portions and in a much more efficient sort of way. So we'll have to see how that all plays out. And again, I think it's probably going to be a challenging environment over the next couple of years. So I would imagine advisors are going to take these a lot more seriously than they have the last couple of years. I know one of your, go ahead, I'm sorry.
Yeah, do you think though it takes another rather dramatic, sustained, not prolonged, hopefully, market correction for them to get for the alternatives generally to get a second win as it relates to more retail investors? That's, I guess.
Yeah, so there's a couple things there. One is I would agree with you. I think that liquid alternatives, kind of the first generation, I think that many of those failed to deliver on the promise, and they failed to deliver on the promise because they didn't deliver the performance. Many of the firms that offer them really didn't have experience being a long short. They didn't really have hedge fund type experience. They just were going where the puck was. And consequently, advisors had a bad experience and they kind of left those and walked away from them. And then they were handsomely rewarded by being in the traditional markets. But what I would argue is if you're looking at an environment where rather than getting the long-term historical average of the S&P, which is 10.2%, you only get 5.4, which is kind of an aggregate of a lot of the biggest capital market assumptions coming from the biggest firms on the street. If your returns are half of what they were, and we know where bond yields are, you need to expand your playbook. And I think that's the role where private equity, private credit, some of these hedge fund strategies definitely start to make sense. And then the challenge becomes, how do you allocate to those and how do you get them in the most appropriate packaging? Because there are some limitations depending on the wealth of a client. So I do think it will have its day. They may not be for everyone, but I'd argue that it's going to be a challenging environment, and advisors at the very least should consider them and have a view on them.
Okay, yeah, that makes sense to me. It is interesting in terms of returns. So one of my pet peeves, which will prevent me from being invited back here, is just the returns on the S&P 500 if you just took the standard equity versus the aggregate bond index, and just the money flows. It's just amazing to me how much money's gone into fixed income over the last 5 years and what the relatively meager returns have turned out to be. I know the equities have presented some volatility challenges which made people skittish, but the disparity in returns over the last 10 years for equities versus fixed, and the amount of money that's flowed, in my estimation, a bit in the wrong way is kind of pretty dramatic. But
I would agree with you. I think there's a real challenge with fixed income. One, I think there's more risk than most advisors think. But to your point about you're not being rewarded for it, right? You're definitely not. You're getting, in many instances, you're getting negative real return because now we're starting to see inflation pick up. So I do think that advisors need to think about, where do I get incremental return? Where do I get alternative sources of income? And what can I do to dampen the volatility that I know was on the horizon in my portfolios? To me, that's the alternative investment story. And again, I think there's a real need for education to think through how those strategies kind of play out in a diversified portfolio. I want to go to one of your favorite topics, and that is this whole the value proposition of the sales and marketing organizations. And again, I think in our previous discussion, we were talking about the fact that maybe COVID just accelerated some of the changes that have been going on in sales. And, how many salespeople do you need? What do they do? Do advisors want, wholesalers in their office all day? I'll kind of give you the floor on this because I know you have a lot of strong views on it, but talk to us about sales and marketing today and where you think it might be a couple of years down the road.
All right, this eliminates the remaining client base almost entirely then. 2 years ago, most asset management firms we work with thought we'll have our field salesperson, wholesaler, cover 300 advisors and just shower them with personalized time and attention. We're going to have the sales desk take on the next 400 or 500, and then we're going to use marketing, digital engagement to attend to the rest. And obviously COVID put everyone at home, and they realized that, wow, maybe we don't have to have 4 to 6 meetings a year in person, and we can still sustain relationships. And these hybrid wholesalers we were developing, maybe everyone's a hybrid wholesaler. And also turns out that no one wants to talk to an internal sales desk person at all, ever. So the notion that they were going to manage relationships faded. So it basically winds up being, we're going to engage you. If you're the right type of advisor, book size, practice type, growth potential, you're going to be showered with a high quality field person who has access to investment specialists and specialists of all type to just protect that relationship. So that's nice. It's nice for the advisors out there. One of the lessons was that advisors really have a small group of firms that they want to work with. And so distributors, home offices, were already pushing back, saying there's too many of you people traipsing around, wasting time of the advisors and not adding enough value. And I think, as you're saying, this kind of expedited the pace of that change. So many firms realize that if we don't have something more significant as a differentiator or a door opener, and if we're just pushing product, then we're not going to get access. And access to advisors is the big battle now. And it's being fought much more in coordination with marketing than it ever has been before, because marketing used to just be basically fact sheets. But so I thought there'd be a bigger change in the industry, but it seems to have reinforced the value assigned to this wholesaling unit, because desperately protecting existing relationships is everything people are trying to do today. And really what the changes are is that you're just not going to have it's a different types of engagement, and maybe not so much of a hybrid and internal, and really just marketing at one end of the spectrum and the specialist with guided by the wholesaler at the other end.
So I'm curious if the footprint changes over time. Are there more Zoom calls, more content, whether it be short form videos or white papers or strategy pieces? Is it more the push out?
That would eliminate any consulting opportunities I have. going forward if I disagree with that. But yes, that is it. It's yes, more Zoom calls, much more attention to making sure you're delivering impact and value and not just presenting products. I mean, advisors have been telling asset managers forever that we can get the information about your products and wherever we want, in our home office or online. So bring us a little bit more. And the ones who've responded have been rewarded with access, and a lot of them haven't yet. But yeah, that is it. That's the solution that people are gravitating to, and I think it's the right one.
Well, Neil, you joke about it, but I appreciate your candor. I really appreciate all your perspective on it, because I do feel like the world is kind of changing around us. And, it's so often that, we have somebody who comes on and they've got a bias, an asset manager who has something to sell, or an advisor who thinks, their solution is the best. I really appreciate your vantage point of kind of looking at this changing world and sometimes saying things that aren't the consensus, which I think is healthy for all of us. We're getting close to the end of the time here, and I did want to just remind folks, on your console, you can find an article that Neil wrote that appeared in the Investment and Wealth Monitor. It's a terrific article that covers a lot of the ground that we covered here. And then IWI also has a report that I think, at least as a survey, that covers some of the research they had done on the future of wealth management. I think you would find that very insightful. And then I just want to cover a couple of housekeeping things just as we get to the end of the program here, and that is that the Investment and Wealth Institute has really done a terrific job creating a scholarship program that has helped advisors, and I would encourage you to think about it, or at least try to better understand what it does, because I think it's really helped a lot of advisors advance their professional careers and their designations. And I always get a thrill when I look at how many people are impacted and some of the personal profiles around that. So please take advantage of that. For those of you who may be new to the Investment and Wealth Institute, there's certainly an opportunity to learn more about the various designations, whether it be the CIMA, the CPWA, or the RMA. And then I would love for you to consider future educational programs that we're doing, whether it be the Exceptional Advisor webinar series, some of the conferences, podcasts, so on and so forth. Lastly, I'd love to give a plug for our next upcoming Exceptional Advisor webinar series. One of the topics, and Neil, I don't know if you have a point of view on this, but one of the topics that has come up constantly with our editorial advisory board is crypto. What do we think about it? Bitcoin, Ethereum, you name it, what is going on? How should advisors think about it? Do they have a role in the portfolio? Are they an asset class? It's just going to be interesting. So Keith Black, who is really the primary thought leader at Kaya, has really done a tremendous amount of work on this topic. So he's going to be my guest. He's also writing an article for the upcoming Investment and Wealth Monitor, but I think that's going to be really timely. And I'm curious how that discussion goes and the types of questions we get. So with that, Neil, thank you so much. We really appreciate, one, spending the time with us on the article, and then two, having the open dialogue with us here today. It's great value and perspective to hear from somebody who's really sitting with the asset managers and helping them think through their strategies. So thank you so much for joining us here today.
Thank you.
And that concludes our Exceptional Advisor webinar series. We hope you can join us for future webinars. And again, please visit the Investment and Wealth Institute website to learn more about all the offerings that the Institute provides. Thank you all, and be safe.